My dad has been telling me for years to take a look at Enterprise Product Partners, or EPD. This is a high dividend, Dividend Aristocrat stock, and I've never really looked at it. And I came across this article from Dividend Sensei, and it's really good. If you're interested into EPD or MLPs, high dividend stocks, I think you're going to really enjoy this article. The article is titled Enterprise Product Partners, an A-rated 7.3% yielding Dividend Aristocrat with room to run. And this is part of a new series that I created on the channel. I'm reviewing Seeking Alpha articles here on Thursday while still doing my regular Sunday videos that I've been doing on the channel for the last 5 years. Now, EPD is one of my dad's largest positions, and he's been talking about it forever, and he keeps telling me, or has been telling me for years, hey Jake, you got to check this company out. And I've always kind of brushed it off because I'm not really big on energy, and I don't know the sector as much, and so I've always preferred to just get exposure to energy stocks through SEHD, for example. Like, I own Chevron and Exxon through SEHD, so I just thought, well, do I really need the single stock risk? But this article was very, very well written by Dividend Sensei. So this is going to be the second article that I've reviewed from Dividend Sensei here on Seeking Alpha. I've been following him for years. So yeah, I really like his work here on Seeking Alpha. I really enjoy reading his articles. What I liked most about this article was he really breaks down the fundamental analysis of the stock very clearly. I think my favorite part about the article is where he talks about the tax implication. So MLPs are a little bit different, and a lot of investors can kind of be on the fence and be uneasy to invest into a company like EPD, MLP is a master limited partnership. He very clearly explains how the tax implication works, whether you're here in the United States or international. So I think that's probably the most important thing to consider when you're investing into a company like EPD. One of the things that I would have liked, or my only criticism with this article, is you don't really come out of it understanding more about what the company does. It's more focused on the fundamentals of the stock. And so I wish there would have been a little bit of a snapshot around, the company itself. But yeah, like I said, I've never considered buying EPD before, but after reading this article, I'm now open to actually including EPD into my portfolio. But it's not for everybody. It is a high dividend stock, and so something you absolutely want to consider. So with that, let's take a look at the article. The summary here is Enterprise Product Partners is a high quality A-rated aristocrat with a 7.3% yield and 16% undervaluation, offering significant return potential. EPD is one of the few high-yield blue chips to keep up with the tech-dominated S&P this year and has plenty of room to run. EPD offers 23% upside potential in the next year, 70% in the next 3 years, and 141% in the next 5 years, and 13% to 14% long-term annual return potential. Now this is he'll get to this in a second, but this is based off of the price to earnings ratio and where the stock has historically traded. And so if it were to go back up to historical norms, that's what he's referencing here. So when you read articles and they reference, return potential, that's what they're basing it off of. Moving on here, it's industry-leading management quality, credit rating, and 50-plus year growth plan make it the quintessential buy and hold forever investment. 50 years. They're looking 50 years into the future. Holy cow. I've not seen that before. I mean, what company puts together a 50-year plan? Maybe a utility company, but holy cow. So EPD's tax-advantaged income allows for permanent tax deferral across generations, but there's significant tax complexity this article outlines, especially for foreign investors who need to be kept in mind. I'm Dividend Sensei, aka Adam Gallis. He is an Army vet and he runs an investment group here on Seeking Alpha. So he starts the article off with, it's been a heck of a nice value rotation in recent weeks. He shares a screenshot here of value stocks surging these last couple of days compared to more growth stocks kind of retreating. And it's a little bit of this rotation from growth into value. It was a fantastic July for my favorite high yield aristocrats, Enbridge, ENB, and British American Tobacco, ticker BTI. I own BTI. It's one of my highest performing stocks this year. It's been absolutely on a tear. That and Altria Group have been really, really great. But with the market still near record highs, there are wonderful high yield blue chip bargains. So today I wanted to update Enterprise Product Partners, EPD, a 7.3% yielding dividend aristocrat, still 16% undervalued, which has become one of Wall Street's hottest value stocks. EPD is one of few value stocks keeping up with the NVIDIA-powered market this year. It still offers incredible opportunities, making it ideal for retirees seeking generous and dependable income. EPD is one of the highest quality aristocrats. The only A credit rating in the industry's history is that of the Dividend Aristocrat, champion technically, with a 25-year distribution growth streak. 5-year consensus return potential of 141% equals 18% annually versus the S&P 500's 13% annually. So this is, once again, this is what I was referring to earlier. This is assuming if it were to go back to its historical norm, historical PE, the return potential is greater that of the S&P 500 at today's prices, okay, at today's multiples. So that's very, very important that you understand that. And then the 3-year consensus of 70% with a 25% annual return versus the S&P 500. And then the 1-year consensus return potential, at 23%. That's all contingent on if it reverts back to the mean. So don't take that as, set in stone. So what about long-term returns? 7.3% yield and 6.4% long-term growth are 13.7% long-term return potential. This is the historical return since 1998. So this is annually. Some years are going to be lower, some years are going to be higher, but on average since 1998, just under 14%. EPD's average rolling 15-year return is 14% per year, and analysts expect that. Why? So why EPD is a rich retirement dream stock? Now, first, here's a summary of EPD's earnings. Now, this is getting into the fundamentals of EPD, but essentially, I'm just going to summarize this. I'm not going to read it all word for word. EPD has done well quarter over quarter. They've actually grown their cash flow, their free cash flow. They have a good coverage of their distribution. The distribution in this case is the dividend. Now, there is a distinction. It's not considered a dividend. It's considered a distribution. But yeah, when looking at the distribution or the dividend, just to make sure that everybody is on the same page here, they've increased their dividend or the distribution by 5%. And another thing that's very promising with EPD is they're repurchasing common units. Now, because this is an MLP, they're referred to as units and not shares. Once again, it can be a little bit funky. It's MLPs, master limited partnerships, can be very misunderstood. And so it can get a little funky. Just understand that the naming conventions, the way it's a little bit different. So I'm trying to overemphasize this so that you can understand and that you can learn. I don't want to just assume that you understand units or shares and distributions or dividends. So just understand that this is kind of a different world when you're looking at MLPs versus like investing into Johnson & Johnson or PepsiCo, for example. They also have increased their adjusted EBITDA. They've increased their net income. In fact, they've increased it by 12% since the second quarter of last year. So they're seeing really good earnings growth. They're seeing cash flow growth. They're seeing, that the distributions are covered. All great things that you would want from a dividend stock. And then moving on here, their capital investment and debt, they have a good amount of debt. I guess this is the only critique that I have is they've just over 30 billion in debt. But the promising thing here is they have that debt with a weighted average interest rate of 4.7%. So the interest rate is reasonable. They're growing their earnings and they're rewarding shareholders in the form of a growing distribution. And so despite the fact that they have a high amount of debt, the dividend is very covered and they're growing their operations. They have a positive outlook. The bottom line here is that EPD's strong distributable cash flow, robust coverage ratio, and consistent distribution growth make it an attractive option for dividend investors. The company's strategic investments and disciplined capital management further enhance its financial stability and growth potential. EPD is delivering on its historical promise of dependable income, including through a free cash flow, self-funded business model, which is the platinum standard of safety in this industry. That means that EPD, after running the business, generates $4 billion per year in excess distributable cash flow above its distribution. So that $4 billion can be used to pay down debt and to buy back more units or shares of their common stock. So all great things for shareholders. Even with increased gross spending, its free cash flow covers its distribution by 100%, which is unheard of for any midstream before 2020. So they're in a very, very good financial situation. And even though they have a high amount of debt, they have an A-rated credit rating. So they could access capital markets much better than other companies that have a riskier credit profile. So this is such a great position for a company to be in, considering that they do have a good amount or a sizable amount of debt. EPD has returned $4.6 billion to investors in the last year, a record, and it's the most sustainable capital return in the industry. Management expects to cut spending by $1 billion in 2026, which will translate directly into free cash flow that can be spent on acquisitions, buybacks, or higher distributions. And I would argue also debt paydown as well, I would only assume. Credit ratings and credit default swaps tell us the probability of EPD investors losing 100% of their investment through bankruptcy or various periods. According to the S&P, the probability, Standard & Poor's, the probability is 2.5% over the next 30 years. And according to bond investors, it's 2.9%. So out of 100%, you have a 2.5% to go belly up in the next 30 years. That is creme de la creme. Like, that is incredible. This is why my dad is probably telling me to check this company out for so long, because it is a really, really high quality company. The financials are just in impeccable shape, given the debt load. So I do want to say that. These estimates change daily, so if news breaks, we can tell within 24 hours whether the smart money on Wall Street thinks it's a risk to this investment thesis. Long-term bond investors are so confident in EPD's energy transition plan that they are willing to buy bonds that mature in 2078, almost 54 years from now. Smart money is buying bonds for 54 years from now. Holy cow. That's not just the second largest duration bonds in the midstream industry, but also some of the longest bond durations of any company. That's a strong vote of confidence for EPD from the smart money. On Wall Street, that is the buy and hold forever Dividend Aristocrat, which is extra relevant given EPD's beneficial but complex tax profile. So risk to consider. Let's talk about taxes. Guys, this is probably the best part of the article, is he clearly breaks down the tax implications. So if you're considering buying EPD or any other pipeline, midstream, MLP, etc., this is something that you really, really want to pay attention to. So EPD is an MLP, so a master limited partnership, meaning it has a K1 tax form with pros and cons. On the plus side, EPD has tax advantaged income, meaning it's ideally owned in a taxable account. Specifically, the IRS treats distributions, not dividends, as return of capital. That's not the same of return of capital as some ETFs or closed-ended funds. It destroys the net asset value. It effectively gives investors back their money and calls it a dividend. Oh my gosh, if you do not understand, like, he is preaching he's standing on the rooftops just preaching. This is so great. Guys, like, I love this. If you don't understand this kind of stuff, you need to rewatch this, reread this, and truly internalize this and understand this. Let me reread this. This is so important. So the return of capital, when it is true return of capital, that's not the same return of capital of some ETFs or closed-ended funds. It destroys the net asset value, the value of the fund, effectively gives investors back their money and calls it a dividend. What's that old saying? It's a you put a ribbon on a turd, it's still a turd. Or you put, maybe that's not, is that YouTube friendly? I don't care. It's like putting lipstick on a pig. I think that's more the politically correct way to say that. Putting a ribbon on a turd. Putting lipstick on a pig, I think, is more politically correct, or what you would see more online. Oh, man. Okay. Anyways, moving on. When EPD pays you a distribution, it doesn't get taxed. I'm thinking about a pig with a lipstick. It doesn't get taxed. It reduces your cost basis. Okay. After 13.7 years at current yields, you would have received 100% of your initial investment via distributions, and your cost basis will be zero. Do you understand that? After 13.7 years at current yields, you will receive 100% of your initial investment back to you via distributions, and your cost basis will be zero. At that point, EPD's distributions are taxed as long-term capital gains equal to the qualified dividend rate. Okay, so important to understand this. That is return of capital, and that is why he's saying it's more beneficial in a taxable account. And here he has the long-term capital gains tax rates here in the United States, how based off of how you're filing. And remember that most states tax qualified dividends and long-term capital gains as ordinary income. And each state, if you're in California or Hawaii, you're going to be paying a heck of a lot more in taxes. And so the tax implication can be amplified depending on where you live. And in some cases, in some cities or counties, can tax you even higher. So the tax implication is real. Remember that to get the tax benefits of MLPs, you need to own them in a taxable account. That's not entirely true. I want to insert my opinion here that if you do, have them in a Roth IRA and you do end up lowering your cost basis, if you did end up selling them, you wouldn't have any capital gains tax. So ideally, you could go either route, but he's arguing in this case for a taxable account. There's pros and cons to both. If you live in Portland and are in the top tax bracket, when your tax rate, once the cost basis hits zero, is 23.8% federal plus NIIT plus 9.9% state income tax, 4% city. Man, Portland, holy crap. You got a 38% peak tax rate for some investors. When the MLP units are eventually sold, the investor must account for the recapture or of the depreciation, other deductions, taxed as ordinary income. The remaining gain, which is the appreciation in the value of the units, is taxed as capital gains. The tax headaches are based on the need to account for depreciation, meaning the EPD is a wonderful buy and hold forever, ultra high yield aristocrat. If you never sell, you never have to worry about depreciation recapture. Moreover, you can obtain permanent tax deferments for yourself and your family. So that is absolutely an advantage of having it in a taxable account. If in fact you never end up selling, his argument is very, very valid. If you do end up selling, you could have it in a Roth IRA and it would be fine. But if you never sell, it's actually not bad because you're not going to have the depreciation recapture. Now, if you invest into real estate and you're depreciating your assets, you understand this. If you don't invest into real estate, this is probably going to go over your head, and this is a good learning for you. For all of you real estate investors, you're like, oh, okay, that makes sense. If you don't invest into real estate, you probably don't understand a lot of this. So it's a lot of information, and it's very, very important, especially if you want to grow your net worth and really up your game in terms of understanding how the tax treatment works, especially here in the US. So moving on, permanent tax deferment. If you never sell EPD, then your original cost basis worth of distributions, 14%, 14 years of payouts at today's yields are tax-free. When your heirs inherit your units, the cost increases to the price on the day of your death. That means they can sell 100% of the position with zero taxes, or they can continue to own and receive 100% of the new cost basis in distributions tax-free. Now, we talk about generational wealth. That sounds good to me. Every generation can continue to pass on EPD, and each time the cost basis steps up, it can lock in exponentially more tax-deferred income. It's similar to the 1031 exchange in real estate, which allows you to roll over proceeds from a property sale to buy new property without paying capital gains tax. This is why I really, really like this idea of EPD. Like I said, I've never really looked into EPD in detail, and by understanding this and reading this, I'm just like, holy cow, it's like getting the advantages of real estate, the tax advantage of real estate, without having to invest into physical real estate or into a REIT. So I really like the appeal of that. This approach can defer hundreds of thousands or even millions of dollars in safe and dependable income over several generations. The downside, why isn't everyone in love with MLPs thanks to this incredible tax deferred status? The downside of MLP tax treatment. Many MLPs operate in multiple states, which can subject investors to state income tax filings in each state where the MLP operates. This can add significant complexity and potentially increase the investor's state tax liability. Technically, the pass-through nature of MLPs means that you should file state income tax returns with every state an MLP operates in. Most states require tax filing if your net income from any source is $1 or more. Does that mean MLP investors have to do that? According to Bob Mann, a CPA and vice president of TurboTax, it's not worth the aggravation whether you do returns yourself or hire a CPA. Fortunately, states follow a reasonableness standard. According to the tax professionals and experts, while the technical requirement exists, the practical enforcement varies. Bob, a CPA and vice president of TurboTax, suggests that it may not be worth the aggravation to file returns for minimal amounts, and states often follow a reasonableness standard. This implies that states may not aggressively pursue tax filings from individual investors for small amounts of income. The reasonableness standard means that states may not enforce the filing requirement for trivial amounts of income, recognizing the administrative burden it places on taxpayers. This is especially true for individual investors with minimal income from the MLP in those states. However, some investors will not feel comfortable with the reasonable standard for individual states, since technically it's at each state's discretion. The individual state tax authorities decide whether to require an investor to file a tax return. These authorities establish the rules and income thresholds that require a tax return filing. Now, I'm not a CPA. I'm not a tax advisor. I'm not going to say either way. To each their own. I'm not even really going to give my opinion on there because that's my opinion. I don't want to negatively impact anybody's way of thinking on how to do that. But what I will say is I'm going to read up more on this reasonableness standard and how serious it is. So something to definitely consider. Anyways, moving on, taxable holdings for foreign investors in MLPs. Foreign investors in MLPs are subject to specific tax withholding rules due to the nature of the income and the U.S. tax regulations. Here are some of the key points regarding the tax withholdings for foreign investors in MLPs. So I'm not going to read all of this through because this is very technical and it's only for international viewers. If you are international and you're considering this MLP and EPD, just pause the video. I'm going to scroll through here. You can pause it and you can read up on it if it's interesting for you. Like, for example, I remember when I was living in Germany, I had to file this W-8 Ben or whatever. So it only really applies to international investors. And so if you are considering it, I would highly recommend pausing the video, or there's a link in the description below to this article and you can check it out and you can read it through. EPD has the long-term risk management chops to be an authentic buy and hold forever stock, and its stable business model, including plans for a post-fossil fuel transition, makes it one of the few MLPs that can safely be owned with a perpetual time frame. However, it's important to remember that any business can fail, so anyone buying EPD to generate passive income indefinitely will have to bear the single company risk that comes with all individual stocks. 65% of energy stocks since 1980 have fallen 70% plus and have never recovered. I'm 80% confident that EPD will never suffer a permanent catastrophic decline. I don't like that he wrote that in there. I think that's a little bit irresponsible to write that, especially on a single stock. I don't like that. And I don't like it when any creator, whether on YouTube or, in an article, a blog or whatever, is saying that's like he's 80% guaranteeing that this will never happen. I think that that's irresponsible. I don't think that he should have included that in this article. I want to give an analogy, but I'm hesitant to give the analogy. It's like the analogy is like I'm 80% confident that it's going to be a fart, but there's still that 20% chance that it's something more than a fart. And it's always a fart until it's not. And then when it isn't, it's a catastrophe. Maybe a bad example, but like it works. It works until it doesn't. It's great until it's not. And that's why I hate seeing that he says 80% confident, but it's great until it's not. And so I never give any percentages, guarantees, confidence on a single stock because you just don't know. You see all the catastrophes that happened with some of these companies in the past. You just don't know. There's things outside of your control. And so I think it's a little bit irresponsible to give a a confidence percentage in something like that. But that's just my personal opinion. However, the future is always uncertain, so there are no 100% probabilities on Wall Street. I like the disclaimer. So yeah, with that, let's go ahead and let's take a look at some of the comments, and we'll wrap it up here. The first comment here is, great article, thanks for all the tax info. Today seems like a good day for me to reflect on why I love EPD so much. My favorite stock, my largest holding, about 15% of my stock portfolio. On days like this, which will be tough for sure, I don't stress whether EPD goes down a bunch. If it does, I'll buy some more, increase my cost basis, and up my cash flow. Between the safety, yield, and favorable tax status, it's a dream stock for me. I mean, if you're retiring soon and you need income, I think this is a great option. And it seems like there's a lot more tax benefits than some of these covered call ETFs. And so something to absolutely take a look at if you're looking for high income today. This is the best tax technical content I've seen in a while. Thank you. That was what I liked the most about this article, is how he broke down how the taxes work for an MLP like this. Another one here, I hold EPD in a Roth account and expect to hold it for a very long time. Initial buy 2019. My thought is that I will not pay any taxes on either the distributions or when I finally sell my position. I like the idea of paying no taxes versus deferred taxes. Now, I kind of like this. I see both sides of this. He makes very good arguments for a taxable account, but if you want to just keep it simple, I personally don't think that there's anything wrong with holding it in a Roth IRA. No taxes on the distributions, regardless of how long you've held it, right? And if you were to sell it, you were to change your mind, there's no taxes on the capital gains, because, you know, when you have it in a taxable account, you kind of limit your options. You're then kind of forced to hold on to it. In a Roth IRA, you can change your mind. So there's pros and cons for sure. Well, all in all, I would give the article an A. I really like the way that he explained the fundamentals of the stock. I like the way that he explained the tax implication of holding EPD. There wasn't a lot of fluff in the article that I found. The only fluff, I guess you could say, is, you know, how he just looks at a chart and says, okay, it's historically traded at X PE ratio. Therefore, if it returns back to, you know, its historical mean, then there's this X amount of upside. I think that's a little bit okay. I see what he's doing. I don't necessarily agree with that because it's more backwards looking. There was no talk of any competitive moat necessarily on, you know, except for their credit. There was a little bit, right, with the credit rating, but I would have liked to see a little bit more on, you know, the company, how they're expanding, what kind of acquisitions have they done in the past, how have they done well, you know, where could they expand in the future, how could the dividend, you know, be impacted, just a little bit of nitpicky stuff like that. That's why it didn't get an A+ for me. So the article gets an A. But yeah, I'm really interested in the stock. I may actually consider adding EPD. It wouldn't be a large position. It would be a small position, maybe 2%. You know, if I were to transition one of my stocks, I would maybe consider replacing it with EPD, but it would only make up a small percentage. What I do like about it is you're getting a 7% yield. I see this comparable to JEPI. I see JEPI as a little bit more conservative, more of like a bond. You're not going to see as much fluctuation in the share price. But I think, you know, having a conservative, you know, 7+ dividend yield growing at around 5% a year, give or take, plus or minus, it's really enticing to me. So it's not something that I would go heavy in, you know, personally, but looking at it at like maybe 2 or 3% of my overall portfolio, I would be absolutely open to it. But yeah, overall, I really liked the article. I thought it was interesting. I'd be curious to hear, you know, do you invest into EPD? What are your thoughts and opinions on it? I'm going to be mixing this up going forward. Every Thursday, I'm going to include individual stock reviews, ETF reviews, portfolio reviews in terms of like how to retire off a dividend portfolio. So the types of topics on these Thursday videos, I'm going to change them up every week. So there's going to be something fresh and new every single week. So I hope that you're as excited as I am about it. I'm loving this new series. I really enjoy it. I kind of have to overcome my stuttering and my speech impediment when I read some of these articles, but I hope that that's not too much of a distraction for you. I'm just a normal guy, just doing my thing, and I hope that you enjoyed it, and I'll see everybody in next week's video. Thanks for watching.